Well, good afternoon, and thank you for joining us today for our first ever Zoom webinar presentation. I'm excited to have an honored guest with us today, who I'll introduce in just a moment. My name is Lauren Graham. I'm the CEO founder of Lauren Graham Co. As you may know, we're a team of certified financial planners helping clients pursue financial freedom in retirement, live generously, and aim to make a positive impact through our specialty in faith-based investing. And so today we're honored to have with us Jason Myhre, who's the founding director with Eventide. Some of you may recognize the name in your portfolios as we've worked with them for many years. Just as a compliance disclosure, this presentation is educational in nature and not a recommendation to buy or sell any security. But just wanted to make sure the compliance folks were happy. And with that, I will introduce Jason Myhre to host the meeting.
Great. Thanks so much, Lauren. And a warm hello to all you folks out on the West Coast. I am Jason Myhre. I'll pull up my bio here for you so you can see a little bit more about me. As Lauren said, I'm a managing partner of a mutual fund company called Eventide. We're headquartered in Boston. We practice values-based and faith-based investing. My day-to-day work is in an area we call advocacy. Sounds vague, doesn't it? What it is basically I'm advocating for the application of our values to investing. And so I end up speaking to a lot of different audiences about that subject. Something you guys, I'm sure, are familiar with, and you'll hear a little bit more about this towards the tail end of this presentation today. So let's go ahead and dive in. I'm going to set the stage for us, and this is not going to come as a surprise to anyone. We are acutely aware of the world that we're living in right now, where the US is still the epicenter of this coronavirus pandemic, which is taking place all over the world. And when it first got started, in the US, we started to see a very scary ramp in the number of new cases that was exponential in nature. And now that seems like it's abating somewhat. And so hopefully we'll continue to see the number of new cases decline. And hopefully we're on the back half of this with light at the end of the tunnel. But as we're all cloistered away in our homes, we know that in many parts of the economy, whole industries have been brought to a halt. And this has, of course, upset the stock market. When the coronavirus pandemic sell-off first started happening, it was actually the fastest market decline in history, believe it or not. Not the deepest decline, but the fastest initial decline. And we reached a bottom, and then the first week off of that bottom, we experienced the fastest gain in the stock market since the 1930s. So it's been a very volatile time. Those of you that have been reading the investment news as it comes through every day may have noticed that on several days, the New York Stock Exchange actually had their trading breakers flipped as the volume of trading activity exceeded market levels, and they had to, of course, turn their breaker back on and in order to resume normal trading. It's been a very volatile time. And I know we've got a lot on our minds right now, but this presentation is intended to help us think about our investments. Whenever times like these occur in the market, we tend to worry and we start to wonder, well, man, is the plan I had before this began still the right plan for me? Is there anything I need to do about my investments? And so hopefully this presentation can help you to gain confidence in a long-term plan. And rather than try to anticipate the economic and market impacts of coronavirus, I think now is the time when we should really reflect on the timeless lessons in investing. As I'll show you, we have almost 150 years of history of investing in the US. And so we're trying to glean the wisdom from that long-term history. I've crystallized these lessons into 5 points, which I'll put up on the screen, and then we'll walk through each of them together. Number 1, keep your eye on the owner, not the dog. Number 2, restrain yourself. Number 3, employ a system that forces you to buy low. Number 4, remember the most powerful force in the universe. And number 5, invest in businesses, not stocks. Let's start with number 1, keep your eye on the owner, not the dog. What do I mean by this cryptic phrase? Well, it comes from what I think is my favorite quote on investing, which was said by this person, Ralph Wenger, who was a very successful investor and portfolio manager. And he once explained how markets work. And this is as recalled by a person named Bill Bernstein in one of his books on investing. The quote reads, "He likens the market to an excitable dog on a very long leash in New York City, darting randomly in every direction. The dog's owner is walking from Columbus Circle through Central Park to the Metropolitan Museum. At any one moment, there is no predicting which way the pooch will lurch. But in the long run, you know he's heading northeast at an average speed of 3 miles per hour. What is astonishing is that almost all the market players, big and small, seem to have their eye on the dog and not the owner." Hopefully, you're starting to make sense of this metaphor. I'm going to make it very plain for you on the next slide here. What we're looking at in this slide is the entire history of US stock investing. I'll point out a couple of things to you and explain how we arrived at this chart. So some of you will be familiar with the S&P 500. That is the most well-known market benchmark. It's used to generalize the performance of US investing in the stock market. The S&P 500, all it is it's the performance of the 500 largest companies that are based in the US. That started in 1926. So that started right about here on the chart. But we actually have historical books and records of the daily stock prices going all the way back to the market's inception, which was in 1871. And so what we're able to do is to take those historical prices and apply the S&P 500 methodology to gain a sense for the total experience of investing using one frame of reference. So that's the data. Now I want to tell you a couple of things we're doing here. Number one, we're adjusting the returns over this history according to the rate of inflation. The reason we do that is to get what's called a real return. And then number two, we're reinvesting the dividends that companies are producing, as that's an important component of their what's called total return. And so I think this is the most correct way to look at the stock market performance. And when we look at it this way, just kind of step back and look at the screen. Look at the remarkably consistent experience we've had for 149 years. I think this is just incredible. The blue line, of course, is the stock market performance, which is typified by the dog in our metaphor, darting randomly in every direction. There's no predicting which way the pooch will lurch. The yellow line is typified by our owner in the metaphor. The yellow line is the best fit line for the blue line. It's a straight line. There's absolutely no curvature to this. And what I think is so remarkable is that just like the owner in the metaphor that we looked at, he's walking northeast at an average speed of 3 miles per hour. If we look at this in terms of a rate of growth, it's been a constant 6.6% growth over that entire history. This is sometimes referred to as the growth constant of the market, or sometimes known as the Siegel's constant, named after a person named Jeremy Siegel from the Wharton School of Business. And I think our task is to try to not get distracted by the blue line and to try to remember the yellow line. I've tried to take this chart up as close as I could to the present day, and you can see that our March sell-off is but a blip on this long-term history. Now, of course, past performance is no guarantee of future returns. And so maybe this virus completely derails this whole history. That could happen. But we have had 149 years with some pretty scary events along the way, including the Great Depression, the Great Financial Recession, et cetera. So I think it's wise to focus on the long-term growth in the market and to not be bothered as much by the movements of the dog. Number two, restrain yourself. What do I mean by this? Well, when we look at the investor experience of investing, we often find that we are our own worst enemy. I want to show this to you. So what we're looking at on this chart is the 20-year annualized returns of various asset classes or investments. We're looking at the period of time from 1996 through 2015. You can see that during that period in history, the number one investment that in terms of performance over that time frame was something called REITs, which is real estate investment trusts. That's investments in things like office parks. you can see that that returned 10.9% per year for 20 years. The next best performer over this time period, you can see, was the S&P 500 at 8.2%. Next, we have a 60-40 blend of stocks and bonds, a 40-60 blend of stocks and bonds, bonds themselves, the performance of gold. This is international stocks. This is our homes rising and falling in value. This is the performance of oil. You can see the rate of inflation. And look at this. Finishing dead last is the average investor. Now, the average investor is, of course, investing in these very same asset classes. And so the question is, how in the world is this possible? How could the average investor in these investments underperform them all, failing even to keep up with the rate of inflation? Well, the Wall Street Journal explains this phenomenon. They say this: investor returns, also known as dollar-weighted returns, incorporate the effect of cash flowing in and out of an investment as shareholders, and here's the key, buy and sell. Investor returns can be lower than investor returns can be lower than investment returns, because shareholders often buy an investment after it has had a strong run and sell as it hits the bottom. It works like this. Someone is shopping for an investment to save up for the future. They look for an investment that's got great recent performance, and they say, wow, look at the return on this investment. And so they put their money in, often after the investment has had a strong run in performance and is at a top. The investment experiences a downturn, as all investments do, and they give up. They say, oh man, I bought a dog. Let me get out of this thing. And so they cash out, often at the bottom. Lo and behold, the investment will recover. They'll pile in again. It'll turn over. They'll ride it to the bottom. They'll give up and they'll cash out. They do this over and over and over again. And it wreaks havoc on their individual returns. And they end up underperforming their own investments. This is a well-documented phenomenon in the investment industry. I would say that this quote here is probably a top 3 all-time quote on investing in terms of people's awareness of it. It was said by Warren Buffett. Many of you will recognize his name. He said this: be fearful when others are greedy, and greedy when others are fearful. Now, let me say, I do not advocate that any of us operate our lives out of the place of fear or greed, but there is a principle here that is timeless. He says, be fearful when others are greedy. What he means by that is, when everyone around us seems greedy and is telling friends and family to get into the market, and everyone's feeling exuberant and euphoric, at times like that, it typically marks market tops. And so we should be, paradoxically, more fearful and cautious. He goes on to say, and be greedy when others are fearful. When everyone is panicking and fearful and cashing out and putting cash under the mattress, feeling like the sky is falling and the world is coming to an end, historically, those are times that have marked market bottoms. And paradoxically, we should be more aggressive at those times. Now, everyone loves to quote this quote. I've heard it so many times. But there is a world of difference between saying this quote and being the disciplined person who puts this wisdom into action. Very, very few people are disciplined to follow this advice. And so I want to look in the mirror here a little bit. This is a book on psychology written by an economist. The person is named Daniel Kahneman. He won the Nobel Prize in economics. The book is called Thinking, Fast and Slow. This is a book that's gotten passed around a lot in my industry. And I'll save you the trouble of reading this book on psychology if you can grasp just the premise of the book, which is described on page 1. The premise of this book is that it is easier to recognize other people's mistakes than your own. It's easy for us to point the finger at the average investor over that 20-year time period that I showed you and to say, oh, those fools. If I had been investing in that time, I would have stuck it out and enjoyed the full return. But when we look in the mirror, we often find those same tendencies and biases that wreak havoc on our own financial plan. And so we must restrain ourselves. I love this quote by Morgan Housel, who says that finance would be better if it was taught by the psychology and history departments at universities. I couldn't agree more. I showed you the history with the dog and the owner. We've just talked about the psychology of trying to dance in and out of the market. and we are our own worst enemy. We need to restrain ourselves. Here's an old school investor, Jesse Livermore, who says that the big money in investing is not in the buying or the selling, but in the sitting. All right, number 3, employ a system that forces you to buy low. Excuse me. We all know this, but when is the best time to invest? When prices are low. So we need to find a way to consistently buy in an optimal fashion. So we're going to talk about that. I'm going to introduce this with an experiment. So I want you to imagine something with me here. This is going to be hopefully enjoyable. Let's all imagine that we were dropped into history somewhere between the year 1920 and the year 1979. So for example, we could be dropped into the year 1935 or 43 or 62, etc. And our task, wherever we're dropped in this period of time, is to invest in the US stock market for the next 40 years. I'm going to give you a choice of 2 strategies you can choose from. Option 1, you can invest $100 a month. Option 2, you can save up that $100 a month, keeping cash on the sidelines, and try to buy the dips in the market. In other words, when the market crashes, you try to time it to where you invest the money you've been saving up right at the market bottom. But I'm going to sweeten the deal on option number 2. I'm going to grant you perfect knowledge of the future so that you don't have to wonder when these market crashes are. You'll know the exact day to invest, and you will always be guaranteed to buy the market at the bottom. The question is, which would you choose? I want you to think about this for just a moment. By the way, just a comment, I do see there's a raised hand. We can't, unfortunately, call on you and privilege your audio. But if you have a question, you can type it in, and we'll be able to see that on our end at the end of the presentation. Okay, so do you invest $100 a month, or do you invest at times when the market has crashed? What do you think? Well, someone actually conducted this experiment. They tried all possible scenarios. For example, if you were dropped into the 1940s, they tried both scenarios for the subsequent 40 years. Here are the results. I'll explain how to read this. When this blue line is above the horizontal dotted line, that means it would have been smarter to choose the buy the dips option 2 strategy. So you can see, if we had been dropped into history in the 1920s, that would have been the best choice. And again, in the late 30s, early 40s, you can see the buy the dip strategy would have been the superior choice. When this blue line is below the horizontal dotted line, that means option 1, investing $100 a month, is the better choice. And I want you to just look at this. Look at how much time the boring, regular, monthly investment of $100 outperforms. In fact, it's 70% of this time. 70% of the time. I think that's pretty remarkable. Now, keep in mind, with option 2, I granted you perfect knowledge of the future, which of course none of us have. For example, have we reached the true bottom of the coronavirus market sell-off, or will the market go down again and reach an even lower bottom? I don't know. I'm guessing that you don't know either. None of us know the future. And if we happen to miss time these buy the dips, which is very easy to do, if we miss time it by just 2 months, then monthly investment outperforms 97% of the time. Quite remarkable. Now, how can this be? What is this magic at play? Well, it's very simple. It's called dollar cost averaging. I'll explain that to you now. It's real simple. It's the practice of investing a fixed amount of money at regular intervals over time. $100 a month is a great example. And I'm going to show you on charts why this works, but I'll give you the explanation here. When we invest a fixed amount of money every month over time, what happens is we will naturally be able to pick up more shares of an investment when prices are low. So let's say for a given month, you invest your fixed amount of money, prices happen to be low, well, your money goes farther and you're able to pick up more shares. And it naturally will purchase less shares when prices are high. Fixed amount of money, prices happen to be high at that time, your money doesn't go as far. Hopefully this makes sense. I want to illustrate this to you using a particular decade in investing called the lost decade in investing. This was the period of the 2000s. It was a really tough period. You can see this is the S&P 500. We experienced two very painful market crashes. This one is the financial crisis, such that for 10 years, the market was actually down 24%, pretty brutal. It would be painful to invest for 10 years and to have lost money, right? Many people say that this was the toughest decade to invest in history. Well, let's look at how dollar cost averaging performs over a period of time like this. So on the top, you can see the exact same chart I showed you with the two market crashes. On the bottom in the blue, what we're looking at is the effect of dollar cost averaging in terms of the number of shares that you're able to purchase. So let's just walk through this. So at the beginning of this period, the market is at a peak, right? You're investing a fixed amount of money that month. Prices are high. You're not able to buy as many shares. In this case, you're able to pick up 3.5 shares. The market crashes, so your money goes farther. The market recovers. Your money doesn't go as far. The market crashes. You're able to pick up more shares, and so on. Hopefully this principle is making sense. Now, if you kind of just look at the screen here, I wonder if you notice something. Take a look at this chart and see if you notice what's happening here. Do you notice that dollar cost averaging is, in effect, buying the dips? Look at the second one, for example. Look at how perfectly in sync that purchase is with the precise bottom of the market. We didn't have to know the future to be able to buy at these optimal prices because we were employing a system that naturally does it for us. In fact, dollar cost averaging purchases nearly twice as many shares when prices are low as when they're high. It is a smart way to accumulate shares in investing. And what's more, your return would not have been the market's negative 24.1% return over this decade through smart purchasing. If you do the math on it, you actually end up where you would have been up by 5.9% over the period. So not spectacular, right? But certainly much better than having lost 24%. Now, there's another reason that dollar cost averaging is far superior to buy the dips, and I'll introduce that to you next. And I'm going to introduce this to you using a survey that is commonly given in the US. You can see this particular survey is conducted by Gallup. I've pulled the one from you can see the date here, it's the middle of 2014. What's interesting about this survey is they're asking people of their recollection of the stock market performance the prior year. So they're asking people in the middle of 2014 how stocks did the prior year in 2013. It's in the history books. People should know what the answer is, right? The way they ask the question is they say, as far as you know, how did US stocks perform the prior year? Did they increase in value, stay about the same, or decrease in value? If they did go up, how much did they go up? And they give people a range of choices. Well, in 2013, the market was up 30%, and only 7% of the American population correctly knew that. This survey has been repeated year in and year out, and here is what we've learned. People are very, very aware when markets crash, but they are very unaware when markets are making gains. So the way we could say this is that we have this asymmetric awareness problem where we think things are worse than they really are most of the time. Now, why is this? I think there's a couple of reasons for this. Number one, I think we tend to worry a lot. But number two, I think if we think about the way in which we often hear the news, there's a famous quote in the newspaper industry. It goes like this: if it bleeds, it leads. In other words, in order for something to make headlines in a newspaper, somebody needs to be bleeding. There needs to be some tragedy in the world. In other words, the news is often bad news. And so I think we get accustomed to thinking that things are a lot worse than they often are. And this disguises the long-term history of the market. Remember back to the dog and the owner. The market corrections were, for 149 years, slight pullbacks on a long-term trajectory of up and to the right. And so the reason dollar cost averaging is superior to holding your money and waiting for the market to crash is not only that it's buying the dips, it's getting you in the market to experience these long-term gains. Here's a quote: "While you wait for the next dip, the market is likely to keep rising and leave you behind." Here's an unlikely quote for us from Napoleon Bonaparte. This was his definition of military genius, and I like it as a definition for investing genius. He says this: "The man who can do the average thing when all those around him are going crazy." Let me tell you something about dollar cost averaging. If you plug away at your investment strategy month in and month out like clockwork, I think you'll have a very smart way to invest. But you're not going to impress any of your friends with your investing program. They're not going to think you're savvy or sophisticated. You're not going to make for interesting dinner conversations. You're going to have friends who have some new idea about how they can try to dance in and out of the market and outsmart the market and to try to time these peaks and valleys. I would just encourage you to dismiss it and to smile to yourself, knowing that you have a system that has been proven for a long period of time. Number 4, remember the most powerful force in the universe. Believe it or not, Albert Einstein once said this: "The most powerful force in the universe is compound interest." Compound interest. Think about the contributions of this man to sciences. He has, studied the natural laws of the universe, and here he's saying, I think, jokingly, but that the most powerful force in the universe is compound interest. Well, what is compound interest? I know you've probably heard the term, but what is it, and why would it be so impressive to a person like Einstein? I'll illustrate this using a classic example in investing. It's called a very expensive cup of coffee. So the average price for a cup of coffee, if you go to Starbucks in the US today or some other coffee shop, the average price is $3. If instead of buying that $3 cup of coffee every day, we socked that money away and invested it, how much would we have after 40 years? If we assume the market's historical growth constant of 6.6%, after 40 years, we'd have more than $210,000. So not enough for a retirement program, but pretty impressive given that all we're doing is foregoing a $3 cup of coffee. Now, why does this grow to such an amount? It's because of compound interest. Now, what is compound interest? If you look this up online, you'll find a lot of very technical definitions. I find a lot of them to be overly academic and kind of wonky. I prefer this layman's definition from Benjamin Franklin. Yes, that Benjamin Franklin. He too was a big fan of compound interest. I'll tell you a story about him in just a second. He said that compound interest is best defined this way. He said it's when your money makes money, and then the money that made money starts making money. I know this seems still vague to you. It'll make sense here in a second. Let's look at the math on our coffee problem. So $3 a day on coffee times 365 days in a year is $1,095. That's how much you're investing. That amount is growing by 6.6%, so that at the end of year 1, you have this amount. In year 2, compound interest starts to kick in. So you invest another $1,095, that's your savings instead of buying coffee. This gets added to what you had from the prior year. And so now this is the amount that's growing by 6.6%, giving you $2,411.58. The following years work exactly the same way. Now let's just consider Benjamin Franklin's definition here. He says it's when your money makes money, and then even the money that made money makes money. In other words, it's not just that you're making a return on your principal investment. You're making a return on the interest that you've made in investing in the prior years. So the interest is also growing. The interest is compounding, so to speak. It is interest on interest. This is what our coffee problem looks like. You can see the yellow line is what we would have invested over those 40 years. That's just the savings of $3 a day. The blue line, you can see that's the $210,000 result. Look at the upward sloping line. That is the power of compound interest. It is a line that bends upward, and it gets steeper the longer you let it go. So it is actually approaching a vertical line. This is one of the reasons why people tell you to get started in investing early, because the longer you let it go, those later years, it is snowballing. Let's look at a more realistic illustration for us. Instead of just $3 a day on coffee, what would happen if we maxed out our IRA? This year, the contribution limit is $6,000. Using the same math and the same assumptions, you can see that over 40 years, you would have socked away $240,000. I suspect that most of us on the call could probably do that with some careful life planning. And you can see that it grows to more than $1 million in retirement. And that starts to be something that we can work with. Now, let me tell you something about Ben Franklin and compound interest. It's a really neat story. He was very impressed with it, as I said. When he passed away, he gave two very modest gifts to a couple of cities in the US. He gave $5,000 to Boston and $5,000 to Philadelphia. He put that $5,000 in an investment account, and he told the cities that they weren't allowed to touch it for 200 years. So take a look at this upward sloping line at 40 years. You can imagine what it looks like at 200. Well, that measly $5,000 has grown to tens of millions of dollars, and the cities of Boston and Philadelphia are still trying to spend that money today. Pretty neat. The reason this works is that time is on my side. Yes, it is. This is from legendary investors, the Rolling Stones. Many of you will know them. Another quote from Warren Buffett: "The stock market is a device for transferring money from the impatient to the patient. We need to let time do its thing, and we need to be patient." All right, fifth and final point, and I think the most significant: invest in businesses, not stocks. What do I mean here? One of the deep convictions that I have at my firm, and that I know is shared by Lauren, is that many people have completely lost sight of what they're doing in investing. Investing used to be about intentionally selecting companies that you believed in, that you felt were a good reflection of your life, to partner with those businesses for the long term through the ups and downs. Well, we've lost sight of that. What do we have today? Most people are trying to profit from the market, like this abstract kind of money game where you're hoping to kind of put your money in and it's going to spit out a higher result. There's a lot of numbers and rules that we put on top of it. We're not thinking so much about investing in specific companies, but really kind of just owning everything. When we take this market-centric view and lose sight of investing in companies, what are we left with? The relationship gets reduced to a relationship that depends on performance. And so guess what? It's going to be a very rocky relationship. When the market is up, we're going to feel great. When the market tanks, we're going to despair and panic. Here's a quote from a professor at DePaul University who describes what it's like to be an investor, what it feels like. Try this on for size. He says, "Retirement accounts tend to just go into mutual funds, where not only do I not have any idea how the companies I have stock in are being operated, I don't even know what companies I have stock in. And these investments tend to be run by an elite of managers whose one preoccupation is with increasing the bottom line, is with profit." Have you ever felt this way? Have you ever wondered, man, what am I owning in my investment accounts? Where are these profits coming from? Do I believe in the companies that I'm investing in? And do I feel good about those companies? Am I proud of the companies that I own? And am I excited about the returns that I'm receiving? Now, fortunately, those of you that work with Lauren Graham as clients, you are in good hands. The vast majority of investors have no sense of connection to the companies that they own. I'll give you the manager side of this. So within the industry, there are many managers who let the numbers do the talking and the deciding. This is just an example. I don't mean to pick on any one person here. There are many that I could have chosen. This is a well-known manager of a hedge fund. And I heard him speak at an investment conference a few years ago where he said this: "I pride myself on not knowing what's in our portfolios." This is a bold statement. So think about this. This is the person who is picking the companies on behalf of his investors. And he's saying that he considers it a point of pride to not even know the names of the companies that he's putting in the portfolio. Now, why would that be? Seems odd, doesn't it? Well, he wants to look at the numbers in as rational a way as possible. So let's say he has a favorite measurement of value of a particular company. If he knew the name of the company, he's saying it would cloud his judgment in a certain way. And this is something that a lot of people really admire. I remember looking around the room when this statement was made, just seeing how it registered on the audience. And you could see a lot of admiration. People celebrate this idea, but I actually think it's a loss when we consider the original purpose of investing, to supply capital to business and to partner with them for the long term. I think we need to remember that when we invest, we're going to own companies. This is, of course, what gives us the rights to receive profits and growth, but it also entangles us in whatever that company is doing in the world. We need to remember that the profits are flowing from real companies doing real things with real products and services and practices. And so since investing is company ownership, I think it's very natural for us to think about ownership types of questions in addition to financial questions. We should have, I think, questions about management teams, questions about a company's relationship to their customers, their employees, their suppliers, the communities they're based in, the natural environment, and even their impact on society. Some of the questions that I think come naturally to mind when we think about companies are questions like these. Would we want to work under the leadership team there? How likely would we be to recommend their product or service in real life to a friend or family member? Would we want our son or daughter to work at this company? If our son or daughter wanted to go work for this company, would we be proud of them for that decision? On a scale of 1 to 10, where 1 is a new flavor of gum and 10 is a cure for cancer, how much value do we think this company's products and services contribute to humankind? And by the way, this might be negative in the case of products and services that we believe harm customers or even destroy life. If we were to walk into the supply center of this company, would we be proud of the quality and working conditions that we observe? What would our reaction be if this company opened an office in our neighborhood, opened a supply center, plant, or factory? And does this company's environmental policy and actions leave a better planet for our grandchildren? Do you see the difference? Do you see that these are the kinds of questions you would ask about a company that are very unnatural seeming to ask about a stock? It's because people have assumed that a stock is just an entity to make or lose money. We must remember there's companies behind this scene. Here's the last and final quote. I really like it. It's about how this company-centric view of investing can be a source of confidence for the long term. So follow along with me as I read this. I know it's a little bit of a lengthy quote, but I really like it. This is from the portfolio manager at my company. He says this: "Many people have had the experience of purchasing a stock, becoming nervous as it declined, and then selling out at a loss, perhaps only to see it go right back up. On the other hand, if a person knows the business the stock represents, trusts the management team at that company, and so comes to believe in that company, these declines are not so troubling. That person is a confident investor because history has shown that great businesses not only endure downturns, but emerge even stronger, making these declines perhaps attractive points to invest further. When you understand the merits of the companies in which you invest and better appreciate what you own, you can transcend a mere chart-based financial relationship in investing. You can then have greater confidence and less stress because you are not buying mere paper or a derivative, but quality businesses you know and trust. After all, life should not be spent staring at a computer screen, watching ticker gyrations, but instead free from needless stress." I think we would do so well for ourselves in terms of managing our stress level with investing if we could reconnect with this original purpose of investing and become excited again about the idea of owning great businesses. So here are the timeless truths for investing. Keep your eye on the owner, not the dog. Restrain yourself. Employ a system that forces you to buy low. Remember the most powerful force in the universe, and invest in businesses, not stocks. I'll put up some important disclosures here for just a moment. As Lauren said, this is not intended in any way to be a investment recommendation to buy or sell. Rather, I'm hoping that you took away from it just some educational lessons on how to think about investing on the whole. And with that, I'm going to invite Lauren back on to potentially maybe take some questions here.
Well, thank you, Jason. Thank you, Jason. I just want to express our gratitude for taking the time to share this wisdom with us today. I think when we first met back in 2009, when I was first exploring biblically responsible investing, and met this group of founders of a small company named Eventide, and it's amazing to see how God is taking you on this journey, on our sort of parallel journeys. But I just want to say we're proud to be working with a company like Eventide that just shares our same philosophy around investing in a way that aligns to biblical values. And we're honored that you took time out of leading a company to be with us today. So thank you.
Yeah, my pleasure. I feel the same way. We have many different relationships in the industry. It means so much to us to find advisors who believe in the philosophy and not just are excited about whatever the result might be. And so it means a lot to partner with those who share our same vision for life and the world. So it's my pleasure.
Yeah,
would you like to try to take a couple of questions?
Absolutely, yeah. So let's dive into a Q&A session. You can use the Q&A tool in your Zoom toolbar to type your question, and we'll see those. If you want to take a look at that, and we'll open it up here to questions.
Yeah, let me say one thing about questions. I know it can be scary to ask a question because we may think that our knowledge of investing is rudimentary. This is very common. So there are no bad questions. If you have any simple questions, we'd be delighted to take those. Anything related to what I said or just about investing in general, I know Lauren would be happy to field those questions. So feel free.
Yeah, and while we're waiting for those questions to come in, we'll give just a minute or two for you to collect your thoughts. But just want to say, just in this unique time period that we're in with the COVID-19 pandemic, as you can see, Jason and I are both working from our respective home offices today as we broadcast this presentation, and we've all learned to adapt, and probably all going a little crazy from isolation and social distancing, but we are, just encouraging our clients to be careful and stay safe. And for our guests today, if you are interested in learning more about our company, you can go to our website at laurengraham.com. And for our existing clients, I just want to make sure to say that we'll continue to be guided by these timeless principles in the portfolio management. So